Welcome back to another Finance Hub book summary video. Today, we will explore the timeless investing principles from Benjamin Graham's classic book, The Intelligent Investor. Published over 70 years ago, this book is still regarded as one of the most important guides to investing ever written. Whether you're new to investing or have experience, understanding these core concepts can help you make smarter decisions in today's unpredictable markets. The key takeaway from Graham's philosophy is the idea of value investing. Rather than chasing trends or reacting to daily market swings, Graham advocates for focusing on the intrinsic value of a stock. This means looking beyond the price fluctuations and understanding the true worth of a company based on its assets, earnings, and potential for long-term growth. What makes The Intelligent Investor so valuable is that its principles have stood the test of time. One of Graham's most famous students, Warren Buffett, used these very ideas to build his fortune and become one of the world's most successful investors. In this video, we'll break down the essential lessons from the book and show you how to apply them to your own investments. So let's dive into the core principles of The Intelligent Investor and learn how you can use value investing to build long-term wealth. What is value investing? Let's start by exploring the heart of Benjamin Graham's philosophy, value investing. Value investing is all about finding stocks that are priced lower than their intrinsic value. But what exactly is intrinsic value? It's the true worth of a company, based on factors like its assets, earnings, and long-term growth potential. This value isn't always reflected in the stock price, which can fluctuate due to market emotions or temporary news events. Value investors don't focus on short-term price movements or market trends. Instead, they look for opportunities to buy stocks that the market has undervalued. These are companies whose stock prices don't currently reflect their actual worth. The goal of value investing is to buy these stocks at a discount, then hold them until the market eventually realizes their true value and the price rises. Here's an example to help explain value investing. Imagine you're shopping during a sale and you come across a high-quality product that's usually priced at $100, but today it's selling for $70. You know the product is worth $100, so buying it at $70 feels like a great deal. In the same way, value investors look for companies that are temporarily undervalued by the market and buy their stocks at a lower price than their intrinsic value. Graham believed that the market is often irrational, influenced by emotions like fear and greed. Stock prices can swing wildly based on rumors, news, or short-term speculation. But value investors don't chase these trends or get caught up in the hype. Instead, they focus on the financial health of the company, looking at things like balance sheets, income statements, and future earnings potential. When they find a stock that is priced below its intrinsic value, they buy it and wait patiently for the stock price to rise over time. This long-term approach requires patience, discipline, and the ability to stay focused on the company's long-term potential. Value investing isn't about making quick profits. It's about buying quality companies at a discount and holding them for years to reap the benefits. Many successful investors, including Warren Buffett, credit value investing with helping them build significant wealth over time. In the end, value investing is about making rational decisions based on solid data, rather than getting swept up by the emotional swings of the stock market. It's a proven strategy that has stood the test of time, helping investors avoid speculation and focus on the true value of the companies they invest in. Mr. Market and emotional investing. Now, let's explore one of Benjamin Graham's most famous and enduring concepts, the Mr. Market analogy. This metaphor represents the emotional and often irrational behavior of the stock market. Graham introduces Mr. Market as a business partner who offers to buy or sell your stocks every day, but his mood is constantly shifting based on the latest news or market sentiment. Some days, Mr. Market is euphoric, convinced that everything is going perfectly and he offers to buy your stocks at a high price. Other days, he's pessimistic, worried that the world is falling apart and he offers to buy your stocks at a much lower price. The key point is that Mr. Market's behavior is driven by emotions, fear, greed, and everything in between, not by a rational assessment of a company's true value. As an intelligent investor, your job is to ignore Mr. Market's emotional outbursts and focus on the intrinsic value of the stocks you own. You don't have to accept his offers, especially when they don't align with the value of the company. Instead, you wait for opportunities when Mr. Market is offering you stocks at a significant discount to their true worth or when it makes sense to sell at a higher price. The idea behind the Mr. Market analogy is simple. The stock market's day-to-day fluctuations are often driven by speculation and sentiment, not logic. Investors who react to every up and down in the market are likely to make poor decisions, buying when prices are high and selling when they are low. Graham's advice is to remain calm and rational. Instead of trying to predict market movements or follow the crowd, focus on the long-term value of the companies you're invested in. For example, during the dot-com bubble of the late 1990s, tech stocks soared to irrational highs as Mr. Market was in a state of euphoria. Investors who bought into the hype paid too much for overvalued stocks, but when the bubble burst, those stocks collapsed and many investors lost significant amounts of money. Those who stayed rational and didn't follow Mr. Market's emotional highs and lows were better able to protect their portfolios. The lesson here is clear. Don't let Mr. Market's moods dictate your investment decisions. Focus on value, not emotion, and be patient. Over time, the true value of a company will be recognized, and that's where long-term investors succeed. The margin of safety. One of the most important concepts Benjamin Graham emphasizes in The Intelligent Investor is the margin of safety. This principle is essential for minimizing risk and ensuring long-term success as an investor. The margin of safety refers to the difference between a stock's intrinsic value, what you've determined the company is truly worth, and its market price. Graham's advice is to only buy a stock when its market price is significantly below its intrinsic value. Why is the margin of safety so important? Because no one can predict the future with certainty. Even the most thorough analysis might miss something, or unexpected events, like an economic downturn or changes in company leadership, could negatively affect the stock's performance. The margin of safety acts as a buffer that protects you from making costly mistakes. By paying less than the company's true value, you reduce the risk of loss even if the stock doesn't perform as expected. Let's look at an example. Suppose you determine that a stock's intrinsic value is $100 per share, but it's currently selling for $70. This $30 gap is your margin of safety. By buying the stock at a lower price, you create a cushion that protects you in case your analysis was slightly off, or if the market takes a temporary dip. Essentially, the margin of safety gives you some room for error, ensuring that you don't overpay and reducing the likelihood of a significant loss. Graham believed that this principle was critical because of the inherent uncertainty in investing. No matter how well you analyze a company, there's always a chance that something unforeseen could happen. By buying with a margin of safety, you're giving yourself a form of insurance, protecting your investment from unexpected market fluctuations or miscalculations in your analysis. This principle also helps you stay disciplined as an investor. Instead of jumping on every opportunity, you wait for the right moment to buy when the stock is priced below its intrinsic value. It's about being patient and not rushing into investments just because of market hype or fear of missing out. Warren Buffett, a disciple of Graham's philosophy, has frequently mentioned that the margin of safety is one of the most important concepts he applies in his own investment strategy. In short, the margin of safety protects you from uncertainty and helps you avoid overpaying for stocks. By applying this principle, you ensure that your investments have built-in protection from the risks that come with investing in the stock market. Defensive versus enterprising investors. Benjamin Graham divides investors into two main types: defensive investors and enterprising investors. Understanding which type you are can help guide your investment strategy and determine how much risk and effort you're willing to take on. Let's start with the defensive investor. This type of investor is primarily focused on capital preservation and minimizing risk. Defensive investors typically prefer safe, stable investments that don't require constant attention. Their goal is to achieve satisfactory, consistent returns without taking on too much risk. Graham describes defensive investors as people who either don't want or don't have the time to actively manage their investments. Because of this, their approach is built around simplicity and security. Defensive investors often stick to a balanced portfolio of stocks and bonds. Graham recommended a 50-50 split between stocks and bonds for defensive investors. This balance helps to reduce risk while still allowing for some growth. Defensive investors tend to favor blue-chip stocks, large, well-established companies with a history of stable performance. These stocks may not offer high returns, but they are known for being reliable and less volatile. Now let's talk about the enterprising investor. This type of investor is more active and willing to take on greater risk in exchange for higher potential returns. Enterprising investors are constantly on the lookout for undervalued stocks and special opportunities. They are willing to put in the time and effort to research and analyze companies to find stocks that are priced below their intrinsic value. This approach can lead to higher returns, but it also requires more involvement and a deeper understanding of the market. Enterprising investors often look for bargain stocks, companies that the market has temporarily undervalued. This could happen because of market overreactions or temporary bad news that doesn't reflect the company's true value. By identifying these opportunities, enterprising investors can profit when the stock price rises to reflect its intrinsic worth. It's important to remember that being an enterprising investor doesn't mean being reckless. Graham emphasizes that value investing principles, such as buying with a margin of safety, still apply. The difference is that enterprising investors are more engaged and are willing to actively seek out undervalued stocks. In the end, whether you're a defensive investor or an enterprising investor, comes down to your personal goal, risk tolerance, and the amount of time and effort you're willing to put into managing your portfolio. Neither approach is better. It's about finding the strategy that best suits your personality and financial goals. Stocks and bonds. One of the key decisions every investor faces is how to balance stocks and bonds in their portfolio. Benjamin Graham believed that finding the right balance between these two asset types is essential to managing risk, while still allowing for growth. Both defensive and enterprising investors need to understand the role stocks and bonds play in their investment strategy. Let's start with stocks. Stocks represent ownership in a company, and their value can increase as the company grows and becomes more profitable. While stocks offer the potential for higher returns, they are also more volatile and carry greater risk. Stock prices can fluctuate significantly in the short term based on market conditions, economic factors, and investor sentiment. On the other hand, bonds are essentially loans made to a corporation or government in exchange for regular interest payments. Bonds are considered safer investments because they provide a fixed, predictable return over time. They are less volatile than stocks, but the trade-off is that they generally offer lower returns. For the defensive investor, Graham recommended a conservative approach, holding a portfolio balanced between 50% stocks and 50% bonds. This allocation allows the defensive investor to benefit from the growth potential of stocks while also enjoying the stability and security provided by bonds. The idea is to reduce risk by having a cushion of bonds that can help protect the portfolio from stock market downturns. For the enterprising investor, the stock-to-bond ratio can shift depending on the investor's risk tolerance and market conditions. An enterprising investor might hold a portfolio with 75% stocks and 25% bonds, or even more stocks if they are seeking higher returns. However, Graham stressed that even the most aggressive investor should maintain some bond allocation to protect their portfolio from market volatility. Bonds provide a buffer during market downturns, offering stability when stocks are underperforming. Graham's approach to balancing stocks and bonds was also flexible. For instance, when stock prices are high, it might be wise to shift more towards bonds to reduce risk. Conversely, when stock prices are low, the opportunity to buy undervalued stocks might lead an investor to allocate more towards stocks. The goal is to adjust the balance based on market conditions and personal financial goals. In summary, stocks and bonds each serve a distinct purpose in a portfolio. Stocks offer growth potential but come with greater risk, while bonds provide stability and predictable income. Finding the right balance between these two asset types is key to building a portfolio that can withstand market fluctuations while still achieving long-term growth. As we wrap up this breakdown of The Intelligent Investor, it's clear that Benjamin Graham's principles of investing have stood the test of time. Whether you're new to investing or have years of experience, the lessons from this book remain incredibly relevant in today's markets. One of the most important takeaways is the value of long-term thinking, rather than chasing short-term market trends or reacting to daily price fluctuations. Graham encourages investors to focus on the intrinsic value of the companies they invest in. This disciplined approach can help you avoid the pitfalls of speculation and build a portfolio that grows steadily over time. The concept of Mr. Market reminds us that emotional investing can lead to poor decisions. The stock market's ups and downs should not dictate your strategy. Instead, staying calm and focusing on a company's fundamentals will help you make better choices in the long run. Another key lesson is the importance of the margin of safety. By buying stocks at a price below their intrinsic value, you create a buffer that protects you from unexpected risks. This principle helps investors minimize potential losses and makes investing safer, even in volatile markets. Finally, understanding whether you're a defensive or enterprising investor will shape how you approach your portfolio. Defensive investors prioritize stability and lower risk, while enterprising investors actively seek undervalued opportunities for higher returns. In the end, The Intelligent Investor teaches us that smart investing is about patience, discipline, and focusing on long-term value. By applying these principles, value investing, the margin of safety, and rational decision-making, you can build a strong financial future. Stick to the fundamentals, avoid speculation, and remember that successful investing is a marathon, not a sprint. Thanks for watching. Don't forget to like, comment, and subscribe for more insights on personal finance, investing, and entrepreneurship.